When it comes to building an investment portfolio, a lot of us feel like we're just winging it, right? A mix of guesswork, hot tips, maybe a little bit of gut feeling. But what if there was a more scientific way to grow your wealth? Well, today, we're going to pull back the curtain and uncover the single biggest factor that separates amateur results from professional success.
Every single investor faces this exact dilemma. You've worked so hard for your money, and you're putting it to work in the markets, which is great. But are you truly confident in your strategy, or does it all feel just a little bit random?
Let's just be really honest for a second. Is your portfolio built on a solid, data-driven foundation, or is it closer to a bet on what you hope will do well? This is the core question we have to answer, because believe me, the difference in the outcomes is absolutely staggering. And it's so easy to fall into these common traps. First, you've got home bias, where we feel safer investing in what we know, like putting way too much into Indian equities. Then there's recency bias. Oh, this one is a killer. It's that powerful urge to chase whatever did great last year. And then there's just simple stuff like forgetting to rebalance or using the exact same portfolio for completely different goals. These aren't just bad habits, they are genuine wealth destroyers.
But here is the good news. There's a way to fix all of this, and it's based on a secret that professional fund managers, the ones managing literally trillions of dollars, have known for decades. And it all comes down to one incredibly powerful number.
90%? That's it. This single number is the key to unlocking consistent, long-term performance. But what does it even represent? I'll tell you what it's not. It's not about finding the next multi-bagger stock or timing the market perfectly. No, it's something much more fundamental. It is the absolute bedrock of professional investing. And look, this isn't just some theory I cooked up. It's backed by Nobel Prize-winning research. The single most important decision you will ever make as an investor isn't which stock to buy, it's how you divide your money across different types of assets. That strategic choice, what we call asset allocation, is what drives the overwhelming majority of your returns.
So what exactly is asset allocation? Well, think of it as building the blueprint for your portfolio. It's the strategy of dividing your money among different categories, like stocks for that growth potential, bonds for stability, and maybe a little gold as a hedge against uncertainty. The goal isn't to pick the winning horse. It's to build a balanced team that can perform well in any kind of market. Okay, so if asset allocation is the key, how do we actually do it right? Let's break it down. Let's look at how you can move from that gut feeling to a structured, scientific approach, step by step. See, the pros follow a clear system, and you can too. It all starts by defining your personal profile. What are your goals, your timeline? How much risk can you really stomach? Then you select your building blocks from a wide range of assets. Now, the real magic happens in step 3, using data to optimize the mix, to find that sweet spot with the best possible return for the amount of risk you're taking. Finally, you customize it for your specific goals and, this is crucial, you have a plan to rebalance regularly to keep it on track. It's a process, not a prediction.
Now, all of this sounds great in theory, but what does it actually look like in the real world? Let's make this super tangible with a quick case study. I want you to meet Rajesh.
Rajesh has a goal that probably sounds pretty familiar to a lot of us. He's 35 years old, he's investing 15,000 rupees a month, and his big goal is to hit that 1 crore mark in 25 years for retirement. It's a clear, straightforward objective. Let's see how smart asset allocation can help him get there.
So, after using that scientific approach we talked about, this is the optimal portfolio mix for Rajesh. Just look at the diversification. It's not all piled into one thing. You've got a solid base in large cap stocks, a growth engine with mid caps, some global exposure through international equity, that crucial stability from debt funds, and a small hedge with gold. Every single piece has a purpose. Okay, now for the showdown. Let's compare the results. On the left, we have a very common 60-40 portfolio. That's 60% in stocks, 40% in bonds. On the right is the smart allocation tailored specifically for Rajesh. Now, the expected return is obviously quite a bit higher, but look at the volatility. That's basically a measure of how bumpy the ride is. The smart portfolio is actually projected to have a smoother journey. And that combination, well, it leads to a mind-blowing difference in the final amount after 25 years. And this is the payoff, an extra 28 lakh rupees. By using a smarter, data-driven strategy, Rajesh is projected to have 28 lakh more at retirement. That is the life-changing power of optimizing your asset allocation. We're not talking about a small tweak here. This is a massive improvement in his financial future.
And let's not forget this second number because it's huge. He achieves all that extra wealth while taking less risk. The portfolio's volatility is lower. I mean, that's the holy grail of investing, right? Higher returns with lower risk. And it's made possible entirely through intelligent design.
So, seeing Rajesh's results is really powerful. But the real question is, what does all of this mean for you? How can you apply this exact same thinking to your own financial future?
Think about the power of compounding here. Even a seemingly small improvement in your annual return, something you get through better allocation, can create an enormous difference over time. For an investment just like Rajesh's, it can mean over 25 lakh rupees more at retirement. The decisions you make today about your portfolio structure have incredible leverage on your future wealth.
And so, we end right back where we started, with this one question. After seeing the data, the process, and the proof, it's time to take a hard look at your own investments. Are they truly designed to meet your goals? Because moving from a gut feeling to a scientific approach, that isn't just a matter of technique. It's the decision that could very well define your entire financial future.